While everyone's been focused on individual homeowners losing equity, there's a much bigger story happening at Wall Street's most powerful private equity firm. Blackstone's massive $1.8 billion senior housing gamble, a bet that began in 2016 when demographic trends looked unstoppable, is now collapsing in spectacular fashion. But this isn't just about senior housing. As you'll see in this video, Blackstone's real estate crisis is sending shockwaves through the entire housing market, affecting single-family home prices, institutional buying patterns, and creating opportunities for regular home buyers that haven't existed since 2012. And according to the Wall Street Journal's explosive new investigation, we're witnessing what industry insiders are calling one of Blackstone's worst investments in recent years. But here's what makes this different from anything we've seen before. According to the Wall Street Journal's detailed analysis published in November 2025, Blackstone is liquidating 90 senior housing properties with confirmed losses exceeding $600 million. That's the highest share of portfolio losses since Blackstone's founding. But when you dig deeper into whose money was used to fund these declining properties, a disturbing pattern emerges. The pension funds that invested in Blackstone's real estate partner 8 fund, money belonging to teachers, firefighters, and government workers, are now sitting on what industry insiders are calling the most devastating institutional wealth destruction since 2008. Let me break down exactly what's happening here because the numbers are staggering. In 2016 and 2017, Blackstone went on an unprecedented senior housing buying spree. They acquired 64 properties from HCP for $1.1 billion in 2016, then grabbed another portfolio from Welltower for $747 million in 2017. They weren't just buying a few facilities here and there, they were acquiring entire senior living networks totaling 9,000 units across the country. And here's where it gets interesting. According to the Wall Street Journal analysis, Blackstone paid an average premium believing the aging baby boomer wave would guarantee returns. These same properties, based on recent sale data, they're now selling for 29 to 75% below purchase price. That's a minimum $219 million loss per the Wall Street Journal's analysis of just 39 properties, before we even factor in the $100 million Blackstone spent on property improvements, insurance, and maintenance. Do the math with me here. 39 properties sold for $536 million that were purchased for $755 million equals $219 million in immediate losses. And that's just 39 of the 90 properties. When you project this across the entire portfolio, we're looking at over $600 million in confirmed wealth destruction. And that's just what we know so far. But wait, it gets worse. Much worse. Blackstone didn't just pay cash for these properties, they leveraged their purchases heavily, borrowing $1.2 billion in floating rate debt to finance this buying spree. When interest rates started rising in 2022, their loan payments ballooned and cash flow evaporated. According to the Wall Street Journal, 24 of these properties went into special servicing, Wall Street's polite term for, "we're about to default on our loans." But here's the part that should terrify anyone with a pension or retirement fund. The institutional money that Blackstone used for this senior housing disaster wasn't just from billionaire investors. According to SEC filings reviewed by the Wall Street Journal, major pension funds, including the Arizona Retirement System, $100 million. San Francisco Employees Retirement System, $150 million. North Carolina Retirement System, $200 million. And Pennsylvania Public School Employees Retirement System, $300 million. All invested directly in Blackstone's Real Estate Partners 8 fund that bought these properties. Arizona teachers alone put $100 million into this fund. Pennsylvania school employees invested $300 million. These aren't small positions. They represent meaningful portions of retirement assets for hundreds of thousands of Americans who trusted Blackstone with their future. And now, according to the latest pension fund disclosures, these allocations are showing negative returns for the first time since the 2009 financial crisis. The Arizona retirement system recently reported significant headwinds in their real estate investments, while Pennsylvania teachers are seeing their Blackstone allocation underwater for the first time in over a decade. Now here's where the WSJ data becomes absolutely critical. The specific properties where pension fund money was concentrated are exactly the facilities showing the steepest declines. South Carolina, Florida, Colorado, Illinois. These were Blackstone's senior housing darlings during the buying spree. And according to the WSJ investigation, these are now the epicenters of the institutional wealth destruction. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's keep going. Take Florida, for example. The WSJ reports that Blackstone's Aventura property was purchased for $48.8 million but sold for 75% less after regulators found inadequate resident care, unsanitary conditions, and administrative failures. That's not just a bad investment, that's a regulatory nightmare that destroyed tens of millions in pension fund value. Let me get more specific about the facility-level carnage. In Greenville, South Carolina, Blackstone's senior housing facility saw occupancy collapse from 80% to just 41% during the pandemic. The Wall Street Journal reports this property was recently sold for 60% below purchase price. But here's the truly disturbing part. The Centers for Medicare and Medicaid Services gave this facility a 1-star rating after investigators found it incorrectly prescribed antipsychotic medication to a resident in a way that was likely to cause serious injury, serious harm, serious impairment, or death. Denver and Chicago tell similar horror stories. The Wall Street Journal found that Blackstone sold properties in these metro areas for 70% less than they paid. We're talking about facilities that were supposed to provide care for America's elderly, funded by America's workers, now being liquidated at devastating losses because of operational failures and regulatory violations. American seniors weren't getting the care they paid for, and American workers are losing their retirement savings in the process. And this should really concern you. Blackstone isn't a mom-and-pop operator who can just sit tight and wait for the market to recover. They manage $1.2 trillion in assets with shareholders, fee obligations, and quarterly performance targets. When a $1.8 billion bet goes wrong this badly, they're forced to cut their losses rather than double down on failure. And the pressure is building from multiple directions simultaneously. The $1.2 billion in floating rate debt that Blackstone used to buy these properties is now crushing their cash flow as interest rates have risen from near zero to over 5%. According to the WSJ, loan payments ballooned and squeezed cash flow further until 24 properties had their loans transferred to special servicing. But here's why this senior housing collapse should terrify every homeowner and potential buyer. Blackstone isn't just a senior housing investor. They're the world's largest owner of single-family rental homes through their subsidiary Invitation Homes. The $600 million loss in senior housing is forcing Blackstone to reassess risk across their entire $71 billion real estate portfolio, including over 80,000 single-family homes they rent to regular families. According to industry sources, Blackstone is now tightening lending standards and reducing acquisition targets across all real estate sectors, not just senior housing. When the most aggressive institutional buyer in America starts pulling back, it creates ripple effects through the entire housing ecosystem. And here's the connection most people are missing. The same floating rate debt strategy that destroyed Blackstone's senior housing returns is used throughout their residential portfolio. As interest rates continue rising, Blackstone is facing similar cash flow squeezes on thousands of single-family homes they bought during the pandemic peak. Properties they purchased for $400,000 to $500,000 in 2021 and 22 are now generating negative cash flow as their debt service costs have doubled. This means institutional selling pressure isn't limited to senior housing. Blackstone and other private equity firms are quietly beginning to list single-family homes in markets where their purchase prices no longer make financial sense. Phoenix, Austin, Tampa, Charlotte, the same metros where institutional buyers drove up home prices during the pandemic, are now seeing increased inventory as these firms try to limit their losses. For regular home buyers, this creates both opportunity and risk. Opportunity because institutional selling increases inventory and reduces competition. Risk because when $2 trillion in institutional money starts reassessing real estate exposure, it can trigger broader market corrections that affect everyone's home values. The pension fund losses we're seeing in Blackstone's senior housing disaster also reduce consumer spending power. When teachers in Arizona lose retirement money and firefighters in Pennsylvania see their pensions decline, they spend less on housing, cars, and everything else. This demand destruction can accelerate housing market weakness beyond just institutional selling pressure. Meanwhile, state and federal regulators are cracking down on senior housing operators with poor safety records. When Medicare gives your facility a 1-star rating and state investigators find medication errors that could kill residents, your property value doesn't just decline, it becomes a liability that must be sold immediately. And we're already seeing the institutional liquidation accelerate. Blackstone has already sold 70 of their 90 senior housing properties and is in talks to sell the remaining facilities, according to the Wall Street Journal. Industry insiders know this is code for, "We need to exit this disaster before investors demand answers." The firm has suspended any new senior housing acquisitions and quietly removed senior housing from their target investment categories. Now here's the part that affects the broader senior housing market. When the world's largest alternative asset manager starts dumping an entire asset class at massive losses, it sends shockwaves through the entire industry. Suddenly, a market that pension funds thought was a safe demographic play based on aging baby boomers becomes a cautionary tale about operational complexity. And according to industry data, we're already seeing this play out. Senior housing construction financing has become more expensive as lenders now view the sector as higher risk. Insurance companies are demanding higher premiums for senior housing operators. Even well-run facilities are seeing their valuations decline simply because Blackstone's failure has spooked institutional investors. This explains why other major players are stepping back from the sector. KKR recently announced they're reducing senior housing exposure. Apollo has suspended new senior housing investments. The institutional money that was supposed to solve America's senior housing shortage is now fleeing the sector entirely. What's happening is that Blackstone's spectacular failure is creating a crisis of confidence that extends far beyond just their portfolio. When the most sophisticated investors on Wall Street can lose $600 million this badly, it makes everyone question whether senior housing is really the demographic goldmine it appeared to be. And this is where the story takes an even darker turn for pension funds. Many of these pension fund investments were marketed as conservative, diversified real estate plays that would benefit from predictable demographic trends. Aging baby boomers need senior housing. How could this investment possibly fail? Pension fund managers sold their boards on this logic when committing hundreds of millions in teacher and firefighter retirement money. But according to the WSJ investigation, Blackstone's operational failures reveal that senior housing isn't just real estate, it's healthcare, hospitality, and housing all rolled into one complex business. As one industry insider told the Journal, you're buying an apartment inside of a hotel, inside of a restaurant, inside of a medical clinic. That's a good way to put it. For Blackstone, that complexity proved impossible to manage profitably. For pension funds, it meant their supposedly safe demographic bet became a regulatory and operational nightmare that's now destroying retirement security for hundreds of thousands of workers. The National Association of Real Estate Investment Trusts, predictably, is trying to put a positive spin on all this. They're pointing to other successful senior housing operators and arguing that Blackstone's failure is company-specific rather than sector-wide. But remember, these are the same people who benefit from continued investment flows into real estate. The reality is much different. When you have the world's most sophisticated real estate investor losing $600 million on a supposedly can't-miss demographic trend, you don't get a quick sector recovery. You get a prolonged period where institutional capital avoids senior housing entirely, leaving smaller operators to fill the gap. And we're only in the early stages of this institutional exodus. Here's what you need to watch for in the coming months. First, look for more pension funds to reduce their Blackstone allocations or demand explanations for senior housing losses. When Arizona teachers' retirement money gets decimated in a Blackstone real estate fund, that creates political pressure for pension boards to reconsider their private equity relationships. Second, pay attention to senior housing construction starts. With institutional financing drying up after Blackstone's failure, developers will struggle to fund new projects. This creates a supply shortage that could actually benefit existing well-run facilities, but it also means America's senior housing crisis could get worse before it gets better. Third, watch for regulatory changes in how pension funds evaluate private equity real estate investments. When hundreds of millions in teacher retirement money gets lost on facilities with one-star Medicare ratings and medication errors, that creates pressure for more oversight of where pension dollars go. But here's the hidden opportunity in Blackstone's institutional crisis. For sophisticated investors who understand senior housing operations, Blackstone's distressed selling is creating buying opportunities that haven't existed since the 2008 financial crisis. Properties that were purchased for tens of millions of dollars are now selling for 30 to 70% discounts as Blackstone desperately tries to minimize their losses. The key is understanding that Blackstone's failure was operational, not demographic. The aging baby boomer trend is still real. The demand for quality senior housing is still growing, but managing senior housing requires healthcare expertise, not just real estate knowledge. Regional operators with healthcare backgrounds are now picking up Blackstone's former properties at massive discounts. Companies like Welltower, which originally sold to Blackstone, are buying back some of these same properties for 50 cents on the dollar. For pension funds, this should be a wake-up call about the risks of giving billions to private equity managers who promise expertise in complex sectors they don't actually understand. Blackstone's senior housing disaster proves that Wall Street's sophistication doesn't translate to operational success in specialized real estate. The bottom line is this. Blackstone made a $1.8 billion bet that demographic trends would overcome operational complexity. That bet is now failing spectacularly, with over $600 million in confirmed losses and pension fund money bearing the cost. According to the Wall Street Journal's investigation, we're only seeing the beginning of the institutional wealth destruction as Blackstone continues selling properties at massive discounts. For pension fund beneficiaries, this represents a betrayal of trust where retirement security was gambled on Wall Street's overconfidence. For the senior housing industry, it's a cautionary tale about what happens when financial engineering meets healthcare reality. Are you positioned to understand how institutional failures like this affect your retirement security? If you found this video interesting, please subscribe, share, and watch this one as well. We'll see you next time.